Last night, I produced a YouTube video on Tesla and said that it was a strange animal. Today, I woke up to see that Tesla's stock price has declined from $181 to $163, which is a significant 10% drop in just one day. In that video, I said that, from the latest quarterly report, it looked as if Tesla was no longer a growth stock. Tesla isn't a value stock either. Tesla's stock price has plenty of room to fall before it becomes a value stock. Tesla doesn't pay a dividend and investors are not paid to wait for things to improve. In that video, one thing I did not mention was what price I thought Tesla's stock should be trading at. Tesla's P/E ratio was around 50 times when I looked last night. It should be around 45 times today after its stock price declined. This is still a very high P/E ratio and suggests that the market is still pricing Tesla like a growth stock. However, for a more accurate picture, we should look at the P/E to growth ratio since Tesla is supposed to be a growth stock. In Tesla's latest quarterly results, they reported a 24% growth in revenue but a 24% decline in earnings. A P/E to growth ratio of 1.0 suggests that a stock is fairly valued and a ratio of below 1.0 suggests that a stock is undervalued. So, with a P/E ratio of 45 times, to make a strong case to value Tesla like a growth stock today, Tesla should be growing its earnings yearly by 45%. Of course, this is if we want to see a P/E to growth ratio of 1.0. If we were to think that a P/E to growth ratio of 1.5 is reasonable, which means putting Tesla on par with some Japanese car manufacturers, then a 30% growth in its earnings would be sufficient with a P/E ratio of 45 times. Aggressive price cutting to defend market share is hurting earnings, and it looks like there will be more price cuts to come, according to Elon Musk. It would take a very optimistic investor to think that Tesla would be able to grow earnings this year by 45% or even 30%. Call me pessimistic, but it would be quite amazing if Tesla should even be able to report zero earnings growth this year, which is less bad than the negative earnings growth it saw in the first 3 months of the year. As Tesla does not pay any dividends, Tesla's investors should have deep pockets too, as they are not being paid to wait. Optimism does not bring home the bacon. Tesla has a cult following and cultists are fanatical by nature. They probably don't care about the fundamentals. If we are rational investors, we want to invest when valuation is more reasonable. If Tesla is unable to deliver any earnings growth this year, then its P/E ratio has to be a lot lower in order to make it a more attractive investment. The S&P 500 has a P/E ratio of about 23 times, which isn't cheap either, but it could be where Tesla's common stock has to be if it does not deliver any respectable earnings growth. This would see the price of its common stock at 50% of where it is at today, or about $80 per share, all else being equal.